Hey guys, so this is the Executive AUM Roundtable webinar. Thank you for joining. So I'm going to go through this deck that I've got prepared for you, and let's get started. So today is the 1st of April 2020. A little disclaimer here, but I'll give you these in a PDF when the presentation is finished. So in terms of the content, this is what we're going to go through today. With the questionnaire that I gave out to all of you, this is what I found were the main themes. So this is what I'll go through today. So we'll see what the situation is as it stands, the global response, the structure of the fight back, and we're going to go through the pros and cons of that, what the oil market is looking like, also answering specific questions that you guys have put to me, and we'll open it to the floor for the Q&A lastly. So this is the situation as it stands, and bear in mind this, as you see on the top left-hand corner, is dated the 31st of March 2020. This dashboard was created by a colleague of mine, Babaji, as he at the bottom here, bottom right-hand corner. He's created this dashboard taking data from Johns Hopkins University and creating something which is very interesting for investors and concerned citizens and business people alike. So we're going to go through what the situation is as it stands and go through the most important points. So if you look to the top right-hand corner with the pie chart, you see the rates of death from the coronavirus of COVID-19 rather stand at 4.88%. In fact, more people have actually recovered from the coronavirus than have died, which is a great sign, I think. This is a testament to our healthcare staff globally. And the active cases stand at 75% of the total pie. And if you look towards the colors here, we have about 866,000 confirmed cases, which include total deaths and also those who have recovered. The total active in yellow stands at just over 500,000 at 653,430. This is less total deaths and total recovered, which makes up the confirmed number in total. And in total, 173 countries have confirmed the fact that they have cases of coronavirus and COVID-19 in their respective countries. But a good sign we see right below the country region and the confirmed cases is sort of the league table of cases here. We have the United States at the top, going down to Switzerland at the bottom. This is the top 10. So we have the cases of confirmed cases, recovered cases, the deaths, and also the active cases as we see. And with the black dots next to the recovered cases, we see that in these countries, more people have actually recovered from the coronavirus that have actually passed away, which is again a very good sign. So 9 out of 10 countries, more people have recovered than have passed away, which is really, really good. The only country which this is not the case is the United Kingdom, which cases on the 1st of April stood at 1,793, with recovered cases only being 179, which is something to look at moving forward. And in my opinion, I think we will see cases in the UK rise dramatically in the next 2 days, only really because the measures that the UK government have put in place are probably not as strong as they need to be. And also, if you see this sort of line follows the cases in Italy too. So there's been talk in the UK that we are only really 2 weeks behind Italy. I think that's wishful thinking. I think we're probably about a week behind Italy. We will see, I think, cases rise dramatically the next coming days, but let's see what actually happens. And in the box next to that, on the right-hand side, we see where the cases are the most. And also next to that, we see the cases that have been active, recovered, and deaths, with the United States being on top. So this is the situation as it stands in terms of its physical impact on world affairs. Now we're going to look really into what this has done in terms of markets and comparing the bear market of the coronavirus to other cases. So this is the chart that I pulled up. It's from Goldman Sachs. And this really shows how the bear market of the coronavirus compares to other bear markets of the past. And something which is very unique to the coronavirus is that stocks have fallen sharply and faster than any other bear market listed. And there's obviously a debate now whether we will see a U-shaped or V-shaped recovery, but I think we're still really in the effect of the coronavirus, and looking into the recovery, I think it's too early to speak about a recovery, I think, as we stand. It's gone really sharply down, and this has been taken as a snapshot as of March 13th. So this has changed since then, obviously, but this is the snapshot as we see it, where it stood. And there's a few questions we need to ask ourselves in terms of this graph. Firstly, is if we have reached true bottom in terms of the stock price, whether we have a lot more further to go down, or whether we have reached the true bottom. How deep the V goes, we don't really know right now. I guess it's a wait and see game. And also how smoothly and quickly will we see a recovery. Also, more fundamentally, the question stands at is how do we actually measure the recovery, quote unquote recovery? Is it the health of the financial economy, or is it of the real economy? Do we measure stock prices or unemployment figures? This is really important for us in the world of investment, because a healthy stock market isn't really reflective of a healthy real economy. If we hark back to 2008, in fact, we saw the health of the financial economy take off after 2008, 2009. It bounced back, but those in the real economy didn't really do so as quickly. Those who have lost their jobs and their homes due to the financial crash, it took a lot longer for them to get back on their feet, and lot are still scarred from that event in 2008. So it's something to keep in mind when we look into how we measure such recoveries. Also, I think it's important to see that I don't really compare this COVID-19 coronavirus with SARS back in 2003 and 2004. There have been many who do compare them, but in my mind, I don't think it's a really good comparison for many different reasons. Firstly, the global finance and supply chains have changed and are more integrated than in 2003. The role of China has become more important now than in 2003. They're a global hub of manufacturing, which wasn't as much of the case as it was back then. Also, SARS was a different beast compared to COVID-19. As we see it now, there were under 800 deaths globally, and it stayed relatively contained to China. Also, past performance and decision making isn't really an indication of future performance and decision making too. So having these comparisons financially isn't really too helpful in my opinion. It would make sense more so that the healthcare workers and those in global health look at the comparison between the two. It's more helpful for them, I think, than it is for us in financial services. So let's quickly go on to the global response of the coronavirus. So we have a nation's response is really broken up into three major ways. And this comes as a source from the International Monetary Fund, and is correct as of March 24th, 2020. These are the measures that have been put into place. I've broken them down, or it's been broken down into social/business, fiscal measures, and also monetary and macro financial measures. And in the questionnaire I gave you, the regions in which you guys really wanted to hear more about, or for me to dive into, were Asia, the US, the EU, the UK, and also America and parts of the Middle East also. So this is a breakdown reflective of what you guys wanted to know about. So we'll jump into it straight away now, and I won't mention each specific thing, but as a whole, I think what we can say from these measures is that the financing of each nation's healthcare system has been priority. So a lot of money has gone into funding healthcare and curing or preventing this from spreading even further. That's something that I see being a common thread throughout all of the responses fiscally. But we'll jump into them one by one. So in China, we see a 1-week extension of the National Lunar New Year holiday, a lockdown of Hubei province, large-scale mobility restrictions at the national level, social distancing being a big thing, and a 14-day quarantine period of returning migrant workers. Although from now, we haven't seen very low or no local infections reported as of late, which is a good sign, I guess. Fiscal measures include an estimated 1.3 trillion RMB, or equivalent to 1.2% of GDP on fiscal measures have been approved that are being implemented to stop the increase of the spread. And also tax relief has been waived on Social Security contributions. Monetary side of things in China include liquidity injection into the banking system, including an RMB of 3 trillion in the first half of February, a reduction of the 7-day and 14-day reserve repo rates, as well as the 1-year medium-term lending facility rate by 10 basis points. In the US, we have seen a state level interventions and also federal level interventions into this coronavirus crisis. So we'll mention it high level right now. The US has implemented travel restrictions, social distancing, a declaration of states of emergency, a closure of schools, bars, and restaurants, and also increased testing throughout the country, focused mostly on New York and Connecticut, I believe, as they are the sort of the hubs of infection in the country. In terms of their fiscal responses, the US has introduced a $8.3 billion injection into the coronavirus preparedness and response supplemental appropriations act, a $104 billion injection into the Family's First Coronavirus Response Act, which together provides 0.5% GDP for healthcare, sick leave, small business loans, and international assistance. And there's a lot more in terms of their responses, but these are the key things throughout all the countries that I mentioned today. The monetary and macro financial measures in the US include a federal funds rate lowered to 150 basis points to 0.25 basis points, something which is very interesting for homeowners. I think this is really good. Fannie Mae and Freddie Mac have indicated the 60-day suspension of foreclosures/evictions, and a plan to reduce/suspend mortgage payments of up to 12 months for those affected by COVID-19, which I think is a relief to many homeowners out there who are struggling as it is with unemployment going up, worrying about managing mortgage payments. At least that's something that they can look forward to. In Japan, this is very different to other parts of Asia where we haven't seen a mass increase of cases as we have seen in other parts of the world. And although there have not been mass quarantines in large regions and schools, this is also the case, I think, in Singapore and also in Sweden, I believe. School closures have been implemented together with cancellation of public events, travel restrictions, a work from home scheme, and also social distancing measures have been introduced, not to mention the fact that the Olympics have been postponed until 2021. Their fiscal responses have been quite interesting as well. Japan adopted 2 emergency response packages on February 13th and March 10th for a total amount of 446 billion yen, which is equivalent to 0.1% of GDP. The packages include measures to contain the spread of the virus and enhance preparedness for the healthcare system at the rate of 62 billion yen. Also aid to households such as enhanced paid leave and compensation to working parents affected by school closures. In terms of the monetary and macro financial, the Bank of Japan expanded the overnight terms of repo facilities to enhance liquidity provisions, targeted liquidity provisions through Japanese government bond purchases, and special funds supplying operations to provide loans to financial institutions to facilitate financing of corporates. There's a lot more, but then again, these are just a few of the points which I think are interesting to measure. These are the last 3, the UK, the EU, and India. And for all of you who are in the UK listening to this, I don't think you need to hear a lot about the social/business measures, although for those who are not based in the UK, I'll quickly mention it. Now, unfortunately, the Prime Minister has actually contracted COVID-19, so he's working remotely from home, but he has urged many times and has set out that the British people can only leave their homes for very limited reasons, including basic food shopping, to exercise, one stay, and also essential work. In terms of the social side of things, as the weather improves in the UK, I think this will make a lot of people anxious as to wanting to go outside, but also weighing up the pros and cons of doing so. Travel restrictions, social distancing measures are put into place, obviously, and there's queues around the corner, long queues to get into supermarkets, and some supermarkets have also introduced the fact that you can only go in one person at a time. You can't go in as a couple into supermarkets, which will make it difficult for people to do their shopping. The fiscal measures include a 5 billion injection to the NHS, 5 billion pounds to the NHS. They're deferring VAT payments for the next quarter until the end of the financial year, and will also pay 80% of salaries of furloughed employees to a maximum of £2,500 per employee per month for an initial period of 3 months, and they'll reassess the situation there. The monetary and macro-financial, the Bank of England have reduced interest rates by 65 basis points to 0.1%. They've also expanded the central bank's holding of UK government bonds and non-financial corporate bonds by £200 billion. There's also been an introduction of a new term funding scheme to reinforce the transmission of the rate cuts, with additional incentives for lending to the real economy and especially for SMEs, small and medium-sized enterprises. The EU, I use this as a collective of the other 27 member states. Now, most of them have closed their borders down and also have seen mass shutdowns of public places, schools have closed, travel restrictions have been put into place. The fiscal measures in total include a fund of about 37 billion of pulled together by all 27 member states, which is equivalent to 0.3% of GDP. They've also established a corona response investment initiatives in the EU budget to support public investment for hospitals, SMEs, labor markets, and stress regions. In terms of the monetary measures, the ECB have supported through two main ways, but also many other ways. Firstly, they've supported through an additional asset purchase of 120 billion euro until the end of 2020 under the existing program. Also, an additional 750 billion euro asset purchase program of private and public sector securities, which is under the pandemic emergency purchase program until the end of 2020, trying to keep businesses afloat during this difficult time. India, the biggest democracy in the world and also the second largest populated country, is having big trouble in curbing the coronavirus. So these are some measures that they put into place. Prime Minister Modi, in terms of their social and business, Prime Minister Modi has announced on March 24th that the entire country will go under lockdown for the next 21 days. Although travel restrictions have been put into place, so actually having people going to their villages and to their towns is going to be difficult because the strain on public infrastructure, transport infrastructure is going to be huge given this time period. And many won't be able to make it back because of expenses, because the healthcare systems in their own villages and towns may not be able to handle such an outbreak of corona cases, even if they do go back. So it's going to be very difficult for Indians, no matter where they are, to really, follow the rules that Prime Minister Modi has put down. In terms of their fiscal response, however, 150 billion rupees, about, again, 0.1% of GDP, will be devoted to healthcare infrastructure, including a COVID-19 testing facilities, personal protective equipment, isolation beds, ICU beds, and ventilators. Although ventilators are in big demand globally and are in short supply, so it's going to put a strain on many different healthcare systems globally. And on the state level, one example of fiscal measures have been a 200 billion rupee package in Kerala, which is equal to 2.5% of the state GDP, equivalent to 0.1% of Indian-wide GDP, which includes some direct transfers to poor households, which I guess will help them in this time of need. The monetary and macro-financial measures are as follows. The Reserve Bank of India has indicated that a rate action will be taken in the next MPC meeting in early April, perhaps mimicking the rate actions taken by other central banks in different parts of the world. The Reserve Bank of India has also introduced long-term repo operations, open market operations, and variable term repos to ease any domestic liquidity pressures that the nation will face. So that is, in short, nation's social/business measures, fiscal and also monetary and macro-financial measures to this corona outbreak. We're going to now look into the structure of the fight back and the pros and cons of each. And for this, I really try to think about how we can really frame this, how we can understand this better as investors. So the way that I really put this is as a pyramid with 3 different responses coming from 3 different groups, which is very important to see and very important to keep in mind when looking into the response and seeing how this plays out in the mid to long-term future. So if you stick firstly at the individual response, the main response that humans, I say, well, citizens can do in times like this is self-isolation and social distancing. Their responsibilities are minimal, but also very effective. These measures have been globally coordinated or at least copied by world governments, which is a good thing. And for this part, I'm going to really focus on Italy and use Italy as a case study for the rest of my talk on the individual response. Now, for the most part, this is very straightforward advice, but for obvious reasons, difficult to abide by. Self-isolation has been difficult to maintain due to a loss of earnings, especially for those in the services sector and countries where cash payments dominate over bank payments, like in Italy. This is important as government payouts do not reach all of the people intended if income isn't tracked via bank transfers. Therefore, many hundreds of thousands, if not millions of people and families miss out, not only in Italy, but others which mimic Italy's cash-based economy. There's also obvious psychological strain on individuals, especially if they live alone or elderly or ill. There has been a growing sense of frustration and loss of patience with the Italian people towards their governments, with some posting on social media that there is growing rage and a willingness to break the rules to go out and loot. There's also a real potential for political risk here, and in other countries that share similar characteristics as Italy. I think the way that it stands is initially there's a shock. People need to remain inside. It's difficult to adapt, but eventually you adapt, get used to it. But as your bank, the money in the bank starts to deplete, you start to get more worried, and you start to look towards the government to really help. And if you think that's not as forthcoming as that needs to be, then you're going to get very frustrated. And there is a big sense of political risk in many different countries now as quarantine and shutdowns go over the next few weeks and few months. Well, it's going to be very interesting to see how the people respond to this. In terms of the government response, there are two main ways in which the government respond to this. Firstly is the health testing and treatment, and secondly is the fiscal/monetary measures, as we saw in slides just past. But if we focus on the testing and treatment, first of all, I think we'll jump into something very interesting. Firstly, as I mentioned, a government's responsibility is to provide testing and treatment and preventative measures to their citizens, such as closing of borders and procuring medical equipment and other resources. This is happening, albeit at different levels and different paces across the globe. This part of the response is, however, relatively uncoordinated globally because the level of government response is dependent on the severity of the situation at home. Some have asked why the response was so slow by governments in Europe. And for this, I speak on the UK, for the citizens in the UK. It was actually revealed yesterday that the COVID-19 risk was deemed moderate by healthcare professionals. Also, the fact that reporting of cases from China were not as transparent as needed to see the full infection rate and death rate. This is what some have said in the international community, which is why they blame the slow response from other nations, although this point is contested by the Chinese government. Secondly, we see here their fiscal/monetary measures. There is obviously a responsibility of governments to provide fiscal and monetary measures, as we saw a few slides back. Although as unemployment rates rise, this means less government revenue in the form of taxes. However, government expenditure is rising at unprecedented amounts, putting a significant burden on the government purse, not to mention the future inevitable flurry of requests for government bailouts. And in this case, I look at Virgin Atlantic, which quite recently said that they may be looking for bailouts from the UK government to the tune of hundreds of millions of pounds. This is something to keep in mind because as the situation increases in severity, as companies start to falter and some start to shut down, we'll see a flurry of requests of bailouts from, I think, airlines, from hotel groups, from startups and other industries which really need like a boost if this is to continue as it stands. And we also now look at the international response. Now, the reason why there's a question mark here is because the actual response from the international community has been quite mixed in different ways. So there hasn't been a homogeneous response, unlike the government response and individual response. I think when you come time to international responses, it becomes complex. It becomes hard to navigate, hard to get everyone on board. And the actual cooperation has been lackluster at best, in my opinion. We have the case of Prime Minister Modi from India calling for international cooperation of the G20 and also regional cooperation of partners, where they tried to coordinate responses on that level, but it's been slow and it's been inactive. Also, naturally, it's unfortunate to see that poor countries that need the cooperation the most won't get it. Also, given the fact that they have weak healthcare systems, they'll be the ones to suffer the most. But in the case of the geopolitics of the situation and the international responses of the situation, there's two main characteristics that I like to mention here. Firstly, we look at how certain nations are using this situation as leverage and also as an opportunity to forward their own personal agendas. We see, for example, the case in Hungary, where there have been emergency powers instated onto Viktor Orban. A state of emergency powers have been introduced for an indefinite period of time, which, and I quote, prescribes 5 years prison sentences for those disseminating false information or obstructing the state's crisis response. Following in the same vein, we see different countries, including China and also Egypt, following it, expelling foreign press from their capitals. And also in the case of the USA, we see growing, the US has really ignored calls to temporarily suspend sanctions on Venezuela and Iran and other nations, and in fact has added more members of the Revolutionary Guards and other companies to their sanctions list. So in time of cooperation, those have called for a relinquishing of temporary sanctions, at least countries which the US has strong sanctions on them. The US response has been no, basically. And in fact, we're going to increase the pressure on different nations, showing how this perhaps has been used as a tool to further their own agendas in the international sphere. Secondly, in the 2 points, we have the geopolitical consequences of the coronavirus. And for this, we look at the cases of Libya, France, Hong Kong, and also ISIS. In Libya, and we'll mention these in short, Libya has been fighting ever since the ousting of Colonel Gaddafi in 2011. Libya has really been a hot pot of conflict and also the theater of proxy wars. But given this time, this is something that I find quite interesting in terms of Libya, because both the government and also the opposition group led by General Khalifa Haftar have put in curfews for their citizens and also for their fighters, but from 6 p.m. to 6 a.m., which has actually stopped, at least paused temporarily the fighting in Libya. It's something that no UN or EU treaty could do, but a virus was able to do so. So this is sort of a positive, I guess, unintended consequence of fighting. And also this has been put into place because given the weak healthcare system in Libya, any influx of cases of coronavirus really, they won't be able to handle it at all. So it is good that these measures have been put into place. In terms of France and Hong Kong, they share similar characteristics given the rate of protests against their governments. In France, obviously, protests have stopped for the time being, but they were in their 70th week of protests only 2 weeks ago. And because of the coronavirus, they have stopped these protests, but yet the anger in the people still remains. In terms of Hong Kong also, again, people needed to have stopped protesting, but there's still protests or real big frustrations from the Hong Kong people towards the central Chinese government. And they also see that the central Chinese government hasn't really done much to help them. They haven't really closed borders between Hong Kong and China. Healthcare measures have been slow, they think. So this really adds fuel to the fire for both protesters. Also in cases of nations which are non-democracies or weak democracies, there is a lot of key man risk, meaning for nations which have older leaders in charge, what would really happen if these leaders were to pass away or to get really, really ill? Will there be a change in the regime in their nations? What does that mean to the regional geopolitics and also foreign policy of these nations? This is obviously looking very forward into the future. Big question marks remain, but for example, we haven't seen the leader of Iran out in public as of late. which really puts questions into people's minds as to could this really have wider and longer term geopolitical consequences because of the key man risk that many of these nations face. China also has built a sort of moat around itself. The fact that China has not seen many more cases or zero cases pop up in recent times, this coronavirus threat is an external enemy now. So it's outside of its borders and they want to keep it that way. And we'll see how this plays out in the future as we hear perhaps, second waves of coronavirus come into play and how the Chinese government will respond to such measures. We also have a vying of leadership internationally between the US and China. And we find that China and the US has really faced off for a long time now. But given the fact that China has stopped cases, they're having the time to really respond internationally to nations who need help in the fight against coronavirus. The US has been more insulated. They're trying to figure out the situation themselves, and they haven't really provided much international leadership. Will this play out negatively for them in the future? This is something to wait and see. Now let's look into the response in oil markets, which I think is very interesting. As it stands, oil stands at $20 a barrel roughly right now. It's been the lowest that it's been in the last, for a few years now, for a long time. $20 a barrel is very, very low. Now, oil obviously plummeted by more than 60% over the last 6 months, as you see, the WTI index pegged at $20 a barrel as it stands now. This is due really to a sharp drop in global demand, exacerbated further due to an influx of supply from Russia and the GCC. Saudi Arabia will increase production by a factor of 2.5 million barrels per day. The UAE will also increase production by 200,000 barrels, as well as Russia by 200,000, also Kuwait by 110,000 barrels a day. Now this is because now with fewer dollars coming in for each barrel of crude, Gulf monarchies need to pump much more to maintain some remnants of current levels. Oil never really fully recovered since 2008 high of $135 dollars a barrel, showing the next price high of $122 a barrel in April of 2011 and a low of around $20 a barrel today. So a big spread. This has put oil producing nations on alert, especially those with high break-even fiscal prices like Iran, which have their fiscal break-even at 194 barrels in 2020, and also incentivizes those in the GCC to look for more sustainable and long-term revenue streams. Now, do I think oil will remain at $20 a barrel for the foreseeable future? Probably not. I don't think many nations can sustain such low levels, so we will probably see a rise in oil prices soon, perhaps raising up to $30, $32, $35 a barrel. I don't think they can maintain it at such low levels, so production will probably need to stop at such high levels in the near future, very near future. And looking, as we saw, at Iran's break-even, we see it's the highest out of any nation from this slide here. And this is very interesting for Iran because their fiscal break-even has increased since 2015-16, when President Trump came into power. And the fact that they put so much sanctions on Iran, we see the actual cost going up from, I think, $84 a barrel in 2015 up to just shy of $200 a barrel. So this is really hard for them to maintain. Now, with prices 8 times below their break-even, with no indication, at least in the short term, of them increasing. If they do increase, they definitely won't increase to the levels needed for Iran to maintain a fiscal break-even. As I mentioned, they probably will increase up to $30, $32 a barrel, but it's no way. I don't see them increasing anywhere close to 200, let alone 150 or even $100 a barrel anytime soon. In comparison, Saudi Arabia have their break-even at $83, and Russia have their break-even at $47 a barrel. However, those with large enough cushions provided by their sovereign wealth funds, such as Qatar and the UAE, will be able to weather the storm, at least in the short term. short to medium term. But as I mentioned, these prices are unsustainable. I think that the lowest they've been, and it'll probably be a flash in the pan. They will probably increase by about $10, $12 a barrel, I think. Now, you guys have asked me questions in the questionnaires that I gave out to you, so I want to have a chance to answer some specific ones that you guys have answered, because not all of them could be answered in the slides that I showed you previously. So there was a question asked by Andre, I think, who asked which asset classes are more protected from such pandemics. And in my research, I found this graph from Morningstar, which really gives you a great indication of how the markets are looking like. And if you look at this chart very carefully, this chart shows the returns of each asset class in the month till date. In March, I think this is probably, March. And the size of the box is denoted by the amount of assets under management in each of the groups. So we see equity having the biggest chunk, fixed income the second, allocation funds the third, money markets, and so following them also. So if we see that on average, the only fund to really deliver positive returns of 4.8% in the past month are money market funds, they're in the green. That compares with the average return of minus 3.8% for fixed income and minus 4.8% from property funds over that period. In fact, speaking of property funds, due to the pandemic, we have seen in the UK 14 major property funds suspended so far, with a total of 15.8 billion pounds trapped in various funds. Equities have done the worst, with the worst performance at minus 17.6%, which is bad for equity holders. And as you mentioned, we don't really know where the true bottom goes. So this could exacerbate even further as the crisis continues, or it could recover. But I don't see it recovering anytime soon. We also had a different question here that asked, what will consumer demand be globally post-coronavirus? And I think even asking this question, you infer many things that I don't think we can infer. Firstly, when we say post-corona world, demand globally post-corona, what does a post-coronavirus world actually look like? That's something that we need to ask ourselves before we can answer this question. I think consumer demand globally post-coronavirus isn't really a good term to use, as we don't know what the post-corona world will actually look like. Because in my opinion, from the way I see it, what we'll see in terms of the development of this virus is an ages and stages form of recovery. As we can see already, China have seen no new cases, but Italy sees the most cases. The US cases have been rising steadily, or rapidly rather, over the last few weeks. The UK is catching up. So the stages of the infection globally are not homogeneous. They grow at different time periods and at different severity periods. So consumer demand will be different depending on what part of the world you're looking at, and depending on the recovery of this pandemic. This also doesn't take into consideration perhaps a second wave or even third wave of coronavirus in different parts of the world. So we're nowhere near out of the woods yet. So we need to look at where we stand firstly before we look at what the recovery will look like. But no doubt people are going to be cautious when these measures will be relaxed, hopefully in the next coming months. But we really shouldn't be waiting till after the golden age of a corona-free world as a basis for increased demand in consumer goods. I think there is certain demand right now that we could cater for those in business. So there are opportunities as we stand. There are things that are in demand right now, as I mentioned, or will soon be in demand that can be catered for straight away. And here is a graph of what I think certain producers can be looking at when looking to provide products for the world. First, at the very top, in dark blue, we have medical equipment. Those who provide this, I think, will be in a good position, or who can provide this will be in a very good position. Things like respirators, protective medical equipment, sanitizers, face masks are in global demand right now. And I don't see this really veering off and going south anytime soon. I think we'll continue to see a growing demand as the strain on healthcare workers increases and as the demand from the general public also increases. Also, given the fact that we will see probably in the next coming days and weeks, certain governments put down guidelines where they say that we do need face masks to protect ourselves. not only for healthcare workers, but also for the general public. That's going to be a big time demand for anyone who can produce them. In terms of consumer goods, obviously food is going to be high on the agenda. Essential hygiene items, board games, or even sort of online games would be big. So purchasing of those are going to go through the roof, I think. Indoor fitness accessories will also really be very big. Bicycles, we also see a demand in bicycles going up as this pandemic increases. In terms of the recovery midterm, unfortunately, I think what we'll also see is a growth in antidepressants in medicine, and also alcohol consumption and demand as people weather the storm. In terms of technological innovations, we will see technology for work and play increase in demand. Platforms where people can share experiences, e.g. the House Party app and such, will also increase in demand. In terms of post-corona demand, I think this is very interesting. As people stay insulated at home, there have been reports that we will see in the next 9 months a boom of pregnancies, a baby boom. So again, we'll see demand for equipment there. Also, unfortunately, those couples who stay at home, we also see a rise in divorces, which we have already seen in the UK. Figures have come out which state this. So after this becomes, regulations, after the thing from governments have after government recommendations state become more softer, we'll see those needing to move into new accommodation because of this case. Now, this is a very interesting question that I got also, and this looks into active asset management and also passive asset management. So the question stands at what is the future of traditional asset management, and did active investment in public markets win in a battle versus passive during the COVID-19 crisis? And to answer this question, I think there is a 4-part response, 4 things that we need to keep in mind. First of all, looking at trading volumes. Trading volumes have increased substantially since the coronavirus outbreak. And due to a highly uncertain market backdrop seen, trading volumes in Europe, in fact, have surged to a record of $120 billion in the last week, commencing the 9th of March, according to BlackRock, beating previous records set in the prior 2 weeks and well above the 2019 weekly average volume of just over $44 billion. So the short-term outlook is that since the 20th of February, 80% of UK mutual funds invested in US equities outperformed the market, while 89% of active UK funds outperformed also. In European equities, 91% of active funds beat the market also. However, it is noted that active managers in Japan and emerging markets had struggled to outperform their own benchmarks. So there's a short-term and there's a long-term view of things. The S&P indices versus active funds scorecard has repeatedly highlighted the majority of active funds are able to outperform indices over longer time horizons. In the 2018 report, 75% of UK active equity funds underperformed the index over a 10-year period, while 93% of active US equity funds underperformed the S&P 500. So over the long term, if you have patience and if you are a true investor, then you'll see that indices winning out over active funds. Although in the shorter term, this has been inversed. Now, to really look into why this is so, I think we need to look at the nature of index funds, and that's the 4th point. Now, index funds have been part of the investment landscape and infrastructure over the last 50 years, and growing in importance and relevance, I think, in the last 5 to 10 even. During which time superior performance and low costs have earned them a growing share of investor assets. What's more is that there have been a growth of a trading ecosystem linked indices, most importantly to the S&P 500. The vast majority of trading in index-linked vehicles is carried out by active investors and traders, which explains recent levels of volatility in trading. It is often the case that when people are just looking to raise money, the first thing they sell are the large liquid stocks, so indices get the hardest hit. It's impossible to really avoid losses during these extreme environments, but it does provide an opportunity to defend clients' money relative to index performance for the active managers out there. We also have this question that came out, which is how to help companies cut costs when they need to without endangering the long term. Now, this question is obvious. It depends really on what company or what industry you're looking at. We really need to look into many different things when answering this question, including, the company's fundamentals, their market share, the market conditions, market location, their customer base, whether they're B2B, B2C, their debt levels, and many other things also. But in general, I have put down a few things which companies can do right now to help themselves through this tough situation. And firstly, I think in any of these cases, especially if you're heavy in sales, the one function that needs to remain vigilant are sales. Customers and clients are obviously going through a difficult time themselves. There's increasing panic. They're low or they're tight in terms of their revenue and their cash flow. It's going to be tight. So anyone in sales or customer relations, client relations really need to be vigilant to see what their clients are going through and how they can help them throughout these difficult periods. And to help support this, these are a few things that I think companies can do right now. Firstly, I think companies can really create a coronavirus task force split into two teams. Firstly, one is being in charge of internal communications to staff, and secondly, a second one being in charge of monitoring the business climate, what competitors are doing, and also horizon scanning for future opportunities and pitfalls in their businesses. The one in charge of internal communications, we can call this the home team, will be made up of the HR team, the finance and treasury, and the external team in charge of the international side of things, or the external side of things, will involve people from sales, marketing, and also vendors and consultancies who can help fill the gaps of knowledge of the company. Management also need to take an opinion on what this means for their company and for their employees in the long term. There needs to be clear messaging of management to their employees. They need to have a macro view and also contingency plans put into place. Plan A, B, and C of what needs to happen, or what if something were to happen, how do they respond to this? These views and these outlooks will be informed by their home team and also by their external team when coming up with their responses to this crisis. In times like this, you also need disproportionate communication with staff. You need to help them understand that you're working hard, which really, in actual terms, means, and this depends on how big your team is, of course, with bi-weekly updates on what the company is doing to keep business going, to help staff take advantage of government relief and payouts if need be. So if you need to help by taking government aid, you make sure that your employees know how to do this, how to take advantage of this. I think it's really key. This will help staff understand what the plan is and what plan the management have and what is to be expected of them given this difficult time period. Help staff take advantage of government relief and payouts, as I mentioned in the past, is also very key. There also, I think, needs to be a frequently asked questions platform for staff, where they can ask specific questions to their management teams, and these will be answered in either bi-monthly webinars or videos from management, or through individual responses, again, depending on how big your team is. Now, doing this, I think having a platform or having a place where they can ask their specific questions and then bunching them into themes will help management understand the specific worries of staff depending on where they stand in the company. So management can help more specifically answer specific questions from their employees. One method this can be done is by using surveys of a sort to employees, asking them different questions and helping them understand what their home situation is like and how the company can help them through this time. What's key, obviously, fifthly is financial management. If you have any debt that you need to have restructured because of this crisis, you need to do that ASAP. You can't leave that lost. Being responsible during this time is very important. You can't have panic. You can't have a lack of leadership. And short-term thinking is also key not to have during this time, because you need to break through this. And those companies which have short-term thinking now will pay the price in the future. And if you need to take action in terms of reducing staff hours, pay cuts, kind of bonuses may need to be on the cards too. And if these do need to happen, the above structure, as I mentioned in the slide, will help it easier to implement. When you know what the business climate looks like, when you know what your staff expect and what they're going through, you can help really tailor your responses depending on staff needs and company size. Also something, and the last point here is never to neglect, is the training and leadership and also guidance from external players to help your thinking as management. Outside consultants and consultancies from professionals can help structure your firm's response. Management will need leadership and outside perspective to do this. And if you think you do need this, you need to get it as soon as you can. This will also help you realign your targets for growth in the next coming years, because obviously a crisis like this will completely change what you think you would have achieved if this crisis weren't to be happening. So definitely have outside people who can help restructure your response to this. This is going to be really important for any company, no matter what size you are. So this is the end of my slides. This is how you can contact me. My email address is there, my personal website is there also, and a link to my LinkedIn page. I'm based in London. So Greenwich Mean Time plus 01, I think, is the time zone here. So I'm going to pause it here for a few minutes, and then we're going to start the Q&A shortly. Thank you very much.